Welcome to our February High Rock monthly video. I'm Scott, and with us on the call is Paul, who is the founder of High Rock and our fantastic portfolio manager. We'll talk a little bit about that fantastic in a moment. But first, let's talk a little bit about January. I don't know about a lot of you, but certainly record snow and lots of shoveling for us in Toronto anyway.
Imagine chiropractors were probably busy this past month.
Yeah, probably. And also, I will say that in January, volatility got to levels that we haven't seen since 2020. So that added to a little bit of the craziness in January. Of course, Paul was doing his ski adventure during most of this volatility, or the big spike anyway, back in late January. And Paul, I know you had a fantastic time.
Yeah, I was going up and down the hills, and it looked just like that chart there.
There you go, nice and steep. And certainly that was, to a large degree, why we saw equity markets as weak as they got. And we'll talk about what we were actually doing during that time. But as you can see, U.S. Equity markets were definitely the weakest of equity markets. Global equity markets dragged down by U.S. equity markets, of course. Interestingly, Canadian equity markets were finished the month basically flat, and that in itself I'll let Paul talk about, because certainly it has to do with energy, right, Paul?
Well, I think energy, but I think our banks have also held in quite well vis-a-vis the U.S. banks. But yeah, energy is given, I think it's dragging a lot of folks who were not interested in investing in the energy market back in. So that is helping for sure. But also I would just note too, we did have a bit of a bounce the last few sessions of January, but it would have been a lot worse for most of these indices or most of these asset classes had they not bounced, as you can see in the chart, up until the end of the month.
Yeah, and this does leak a little bit into February, where we've seen a little bit more volatility as well, down and then back up again. So one of the things that if some of you who look at this chart may notice, I've added a new index into this, and that's the balanced ETF from iShares, just to give us sort of a benchmark for how other balanced mandates are looking, and obviously it's a relatively low cost balanced mandate, so that's interesting. But you can see it was down close to 4% during the month of January. Just to keep that in the back of your minds, because when you look at your January portfolio performance, you can see how yours performed relative to a balanced mandate, and that I think should bring some comfort to the majority of our clients, Paul, because what we saw from their portfolios was significantly less volatility than even balanced mandates we're seeing during the month of January. And this is what we're trying to accomplish with our tactical and non-correlated aspects to people's portfors. Yeah, a little bit more. Sorry, did you have
something to say? I'd say as clients look at their performance in January vis-a-vis what happened in the markets, we did extremely well. So you should, and we can talk about more about it, Scott, as you said. But yeah, I'm very pleased with how our portfolios responded to that volatility and weakness.
Yeah, with a lot less volatility. And again, as I always refer, that means we just sleep better at night. So that there's a longer term view of that iShares Core Balanced ETF that I was talking about in the previous slide. And just to give you a little bit of context, you can see back to March of 2020, and that was the move down in the balanced mandate. And you can see that we've basically seen the biggest move down in balanced mandates since March of 2020 occurred in January. And again, if you look at your portfolio, as Paul was saying, you'll see that your balanced portfolio had significantly less volatility than even the balanced benchmark that we're using here, and that should bring lots of comfort to everybody who has a balanced mandate with us, and a good reason to talk us up amongst your friends to say, hey, look, I've got a balanced mandate that lets me sleep at night. We're happy to look at and take on more clients who want to share in that better sleeping situation. Of course, January is just 1 month. We're always focusing on the long term because that is what we believe brings about and requires a lot of the patience and discipline that we put into building and maintaining our client portfolios. So your wealth forecast, always something that we keep in mind when we are making your longer term strategy. But interestingly, on that longer term note, some research from Vanguard, who are people we have conversations with because we do own some of their ETFs in our portfolios, and they did some longer term forward looking research towards the end of last year. We sat down with them and had these conversations, and their views are that we've basically seen the best that a balanced mandate is going to bring, a passive balanced mandate, that for that matter. We've seen the best that we're going to see, and that going forward, investors are going to have to start to manage their expectations around what returns they should be seeing from their balanced mandates. And that should give people some pause to think about what the work that we do, which is part passive, but also we have a fair bit of tactical or a fair tactical approach to our balance mandate. So it does, the High Rock discipline does give investors another option. And if the passive balance mandate going forward isn't looking like it's going to provide the returns that you might want, then it's a reason to be thinking more about what High Rock does. Paul, any comments on that?
No, I'm going to reserve those until we go through some of our models, and I'll explain what happened over the past month.
Yeah, absolutely. Okay. So let's start with the global equity strategy, because for the first time really since March of 2020, we did have volatility in equity markets that we felt brought some better value into equity markets. So we were putting money to work. Certainly not all of it, but we did put about 30% of the available cash to work in most client portfolios. Different clients will have different levels of cash depending on when they started with us. So, or if you've added money over the course of the last year and a half, some of that money you might have noticed was sitting idle for some time. Well, waiting for these opportunities and better value, and that's something that we did have in January, and so we were taking advantage of better value, adding a little bit of equity, global equity ETFs to our client portfolios. And we look at not only value, but we look at opportunity. We know that best opportunities come when markets are showing fear. So we haven't seen all of the fear, so we haven't put all of our money to work. And when we get back to levels somewhat below this 20, or even at or below that 20 level, we'll start to think about adding a little bit more cash into the global equity market. But that is what we've been doing through the month of January, the latter part of January in equity. So you have likely seen some additions to your holdings. And again, if anybody wants to have a conversation around that, you certainly know where to find us, and we're more than happy to have those conversations. Paul, I'll leave it to you to talk about the tactical strategy.
Well, first, I'll just state on the global equity strategy. While I was in the backcountry and pretty much out of pocket for 3 days and near Whistler, that Scott, you did a great job. I think most people will find that the additions to our global equity model that you did over those, really probably one day, but over those 3 days, certainly that I was at a commission, were, if not at the bottom, pretty damn close. So great work on that for sure, and that's exactly why we hold some cash for periods like that. And the market still may go down some. We may never find the bottom when we try to buy stocks or ETFs like that, but we do want to buy big down days for sure. We don't want to be forced in and buy up days. So great work. And now on to the tactical model. So clients, and just as a word of caution, when you are looking at your performance in January, I mean, everybody did well vis-a-vis what happened in the market, and as we saw with a balanced ETF. But clients who had more exposure to tactical, the tactical model did comparatively even better. So some of those clients you would find that they were pretty much flat on the month. And the reason for that is quite simple. It's really our exposure to energy within the tactical model, and one stock in particular, which is Baytex Energy, which is effectively an oil and gas, or well, an oil producer in both Canada and the US. And we've had a position in this for quite some time now. We've been very bullish on fossil fuel energy, both oil and natural gas. So as you can see that chart on Baytex, I mean, most of our clients, depending on when you join, would have a cost base somewhere in the $1.20 area. So at this stage, we're more than fourfold on this stock. We haven't held the position all the way through. We have taken some profits on the way up. And at least once we've added back at a lower valuation. We will continue to maintain a core long position in this stock for the foreseeable future. Some of the other additions that added to performance in the tactical model were our holdings in natural gas high yield bonds. They continue to add value. As you can see there, natural gas actually was up more than oil at the time on a percentage basis, but it is extremely volatile. But nonetheless, we're picking out very good yield on some of these bonds that we've owned in the tactical model. I think that's about it, really, the highlights from the tactical model. So fixed income, we didn't do a lot of trade. I mean, through 2020 and 2021, we were overweight the high yield component in the fixed income model, and just by virtue of some of those bonds being bought back by the issuers, effectively, our weight has been down, which over the past month has been a good thing, and I'll explain why in a second. Preferred shares, we've got a target in mind on a particular preferred share to buy back. As you recall, at the end of December, we had a Sun Life preferred share that was called from us, matured, and we need to replace that, which we are working on. Investment grade bonds, we haven't done anything, and government bonds, now it's February 9th, we had a short-term bond, February 1, called from us, matured rather, and we just replaced that a few days ago, so in early February, with effectively a 1.5-year bond, so very, very short. You could almost consider it cash, and it's a Government of Canada bond. So just overall within the fixed income market, the reason why we, again, have outperformed other balanced mandates on the month of January is because interest rates or government bond yields have backed up substantially. And we are generally underweight government bonds. We are underweight investment grade bonds. We are at our weight in high yield bonds. High yield bonds have less interest rate sensitivity than investment grade, and most certainly than government bonds. So investment grade bonds have been hit, and we've been underweight, so that's helped. Government bonds have been hit in price. When I say hit, I mean they've been lower in price, higher in yield, and that's helped us on a relative basis. And high yield, in fact, those bonds are even a bit lower in price. And something actually I'm just thinking about yesterday and today, maybe even adding back a few high yield bonds in this model. So, and our preferred shares, even though we've had one called and we're what I would consider a little bit underweight, they still have added value. The ones we own, as interest rates go up, these actually help add value to our portfolio. So that's why we haven't been able to buy one over the past month, because they continue to move higher in price. So we're trying to be a little bit patient, but and get some liquidity to buy this particular preferred share that we want. So that's a bit of a synopsis. There wasn't a lot of activity or trade going on in anyone's portfolio in the fixed income model, but those are the justifications and the reasons, part of the reasons, along with the tactical, as to why we outperformed during a pretty dismal month. That's it, Scott.
Well, thanks, Paul. And again, just to reiterate the importance of the benefits of having a more tactical type balanced mandate as opposed to a purely passive mandate, whereby we're able to look for opportunities and take advantage of some of those opportunities and to add value to our client portfolios. And certainly, as we were talking about before, once again, if the passive balanced portfolio looks like it's going to start to bring in lower returns in the future, certainly being part of a more tactical balanced mandate like High Rocks, it makes tons of sense for people. And certainly if you know other people that want something better and different, then let them know that we're here and we're happy to take them on. Okay, Diane couldn't be with us because she's busy on looking after other client issues, but I just wanted to remind everybody that we will be asking you to have a review, and we want you to look at these notices of review, and we want you to take them seriously, because the regulators will be all over our cases if we don't get at least a review in on an annual basis. We would prefer to have every 6 months, but I know some of you have busy lives, but we have to have these reviews at least once a year. Otherwise, the Ontario Securities Commission, BC Securities Commission may slap our hands, and we don't want that. You don't want that either. So it's important that you take notice of this, and Diane will certainly be on your case. Second thing, again, just as we get closer to tax season, there is a list of the dates, and a reminder that you probably would be best to wait until after the beginning of April, until you get your T3 trust income, because there will be some of that, and you don't want to file in advance of receiving those documents. So that's important too. Just something to keep in mind as we approach that. Now, that also brings up conversations around TFSAs and RRSPs. Everybody should be contributing to their TFSA, but we need you to have that conversation with us. We can't just assume that you want us to do that for you. So you need to let us know that we should be contributing for you. We just run into too many situations where some people get to the bank and the bank says, have you contributed to your TFSA? Well, let us do that for you. And at the same time, we're doing it for you. And that creates problems at the CRA level. So we don't want that. So we need to have that conversation with you. And of course, RSP season is coming. We don't want you to leave it to the very last minute. So if you take heed on that, if you do want to have conversations around an RSP contribution and your wealth forecast and how that all comes together, please get in touch and we'll set something up. Okay, Paul, I've said plenty. We would like to thank everybody for taking the time to listen in today. Sorry if we've been a little bit long, but it was a good month. January was, and there's lots of things on the go for us and for our clients, and we just want people to be aware. Anyway, on behalf of Paul and Diane, I'm Scott Tomlinson, and we look forward to having another chat next month.